Recently, a research paper came out ringing the alarm bells about something extremely worrying in the stock market, something that might be pointing towards one of the largest schemes in the history of the financial world. You see, this paper, along with a multitude of others, made the premise that ETFs and a large portion of the stock market might actually be a Ponzi scheme. And right now, we could be in the mother of all stock market bubbles. And their paper, titled Ponzi Funds, broke down how ETFs are creating a self-reinforcing stock market bubble, where fund inflows themselves cause prices to rise, tricking investors into thinking the market is actually booming. So what do they mean by the stock market and ETFs currently looking like a Ponzi scheme? Well, step 1. Investors pour their money into ETFs. Step 2. ETFs automatically buy the stocks in their index. Step 3. Stock prices go up not because of company performance. No, but because ETFs are buying more of them. Step 4. High ETF returns attract even more investors. Step 5 is that new investment money gets turned into even more automatic stock buying. And step 6 is this just repeats itself over and over and over. According to the Ponzi Funds paper, every single day, $500 million is being reallocated in the stock market due to self-inflated ETF returns. Returns that aren't due to the fundamentals of stocks, but because the price pressure of the ETFs themselves. 8 to 12% of investor money into ETFs is solely caused by hype and not actual company profits. The study also found that funds with the highest Ponzi flows later experience crashes of over 200%. Thematic ETFs like Cathie Wood's ARK saw their holdings traded at 20 times daily volume, meaning that even a small investment into the ETF moved stock prices significantly. So what does this mean in English? Well, it's that the ETF buying spree is inflating prices. And this is all kind of on autopilot right now in the stock market. And when this autopilot system finally runs out of investors, the market corrects violently. And so how big are ETFs and Ponzi ETFs right now? Well, here's a pretty crazy stat. ETFs now own 53% of the United States stock market, which is a massive increase from just 20% in 2009. Passive funds, which are ETFs and index funds, sucked in $7 trillion in new investments over the last decade, while active funds only saw a $450 billion increase. Now, these two things mean that the single biggest force driving stock prices higher is not company earnings, innovation, or economic growth. It's mindless ETF inflows pouring into stocks, regardless of whether they deserve it or not. Another strange thing going on with the stock market is, it's Warren Buffett's favorite market valuation metric, the Buffett indicator. It measures the total stock market value versus GDP. In 1999, a very overvalued market. This was at 140% into the 2008 financial crisis. It was 110%. Today, 213%, which is the all-time high by a mile. The market is more detached from the real economy than it ever has been before. In history, Michael Burke, the guy who predicted the 2008 financial collapse, passive investing is the new subprime mortgage bubble. His reasoning is ETFs buy stocks blindly. Good and bad stocks get bought equally. Stock prices are no longer being set by investors or company performance, but by ETF rules. And just imagine if investing in the stock market was like investing in any other type of business. Hey, I want to invest in a restaurant. Cool, which one I want to invest in? Minus one of them. Even the ones with food poisoning violations. You see, the problem here is that if capital is allocated mindlessly, the market stops functioning properly. See, thanks to ETFs, the top 10 stocks now make up over 30% of the S&P 500. Every time an investor buys an S&P 500 ETF, most of that money automatically goes into Apple, Microsoft, Nvidia, Google, Amazon, and a handful of other giants. This inflates these companies' stock prices, making them a bigger part of the index, which then causes more ETF money to flow into them. It's a self-reinforcing loop, where these 10 companies get richer simply because they're already rich. Essentially, this paper is stating that ETFs have effectively rigged the market to favor the largest players. However, we can talk about something that's even scarier. That is the hidden leverage inside of these ETFs. That could turn a market dip into a full-blown financial crisis. A lot of ETFs own the stocks that they actually track. But some ETFs use derivatives, which are swaps, futures, and options to mimic stock performance. These are called synthetic ETFs. You see, instead of owning Apple stock, a synthetic ETF signs a contract with a bank that promises to pay whatever Apple returns. But if the bank goes under or the derivatives market freezes, the ETF collapses. And what is happening today in the ETF space with derivatives is eerily similar to what happened with the mortgage-backed securities in 2008. Because in 2008, banks created synthetic mortgage securities that they deemed safe, and that was until, the market turned. And those synthetic contracts became worthless overnight, and in 2020, bond ETFs actually went through something similar, as they became almost worthless in some scenarios. And we could be seeing that any day now with some of the largest ETFs. So BlackRock, Vanguard, and State Street collectively manage over $25 trillion in assets. They are the largest shareholders in 88% of the S&P 500 companies, and over 40% of all publicly traded U.S. companies. One of these firms is also the largest shareholder. Essentially, 3 companies. 3 own capitalism itself. Here's an example of Apple's ownership breakdown. By the way, Vanguard, 8.7% ownership, BlackRock 6.9% ownership, State Street 3.5%, total 19% control. And since ETFs buy stocks automatically, these big 3 indirectly control corporate governance. They are also slowly gaining more control as the years go by. So a question is, are these 3 companies steering the entire stock market? Well, they claim that they don't control the stock market themselves, they just track the indexes. But consider this, if BlackRock decided to sell Apple tomorrow, it would tank the stock. Their voting power influences CEO pay, mergers, and corporate strategy. They are pushing ESG policies by controlling board elections at major companies. Effectively, these firms have more control over the economy and large companies than most governments do around the world. In fact, it's getting to a point where the SEC is investigating whether one company should legally be allowed to own more than 10% of the publicly traded company. But now here comes the big question. What happens when the music stops? Markets don't go up forever, probably. I mean, they never have. Despite how long or how fast or how short a bull run is, it always ends. One of the only reasons why stocks keep rising every single month is that ETF money keeps flowing in. But if that changes, if ETF money slows down, stops, or even reverses, the entire financial system could collapse faster than a crypto bro realizing he just bought a JPEG for $200,000. And here's another thing, ETFs don't hold cash. When you buy an ETF, your money is used to buy stocks in the fund. If people start selling ETF shares in large numbers, the ETF is forced to sell its stock holdings to give people their money back. This isn't like an old school mutual fund where redemptions happen at the end of the trading day. ETFs sell stocks instantly right into a falling market. And this can create a feedback loop of doom. For example, investors panic and sell ETFs. ETFs are forced to sell stocks to meet withdrawals. Stock prices drop even further. Because of that, more investors panic and sell their ETFs. ETFs sell more stocks, making the crash worse. And just like that, a routine downturn turns into a full-blown crisis. And we've seen glimpses of how ETFs can fuel market chaos before. One of the best examples was the 2010 flash crash, when the stock market plunged nearly 1,000 points in minutes before bouncing back while nobody knew what caused it. ETFs were hit the hardest. Over 70% of trades that crashed that day to 1 penny, or the ones that spiked to $100,000, they all involved ETFs. Another warning came in August of 2015 when the market saw a sudden, massive drop at the opening bell. Many ETFs lost 20 to 30% of their value instantly. even though the stocks they were tracking didn't drop nearly as much. And as mentioned earlier, the same thing happened in March 2020 during the COVID crash, where the bonds got so bad that the Federal Reserve eventually had to step in and start buying ETFs directly to prevent a total collapse. So this raises the uncomfortable question: are ETFs really the biggest stock market bubble in history? And is it ready to pop? Well, as long as ETF money keeps pouring into the market, stocks will stay high. But if investors ever start withdrawing money, even a little bit more than they are right now, it could trigger an unstoppable crash. And who knows why? They would start pulling out their money. Maybe it's an economic downturn. Maybe it's a trade war. Maybe it's a war. Maybe a recession hits something. That would require a lot of people to pull money out from their investments. And since ETFs control over 53% of the stock market, even a slight pullback could have massive consequences. And so that is a stern warning about how ETFs could be the greatest bubble in the history of the financial world. If you want to learn how to grow your YouTube channel, I recently launched a course on my website. Link is in the description down below. I put a lot of work into it, so make sure to check that out. And make sure to click on my next video. And I'll see you guys in my next video in just a few seconds.